everybody, and welcome to today's episode. I have a special guest here on the line today. His name is Steve Bettinger with Swift Lending. He is a private money lender, but also deals with hard money and bridge financing. And so we're going to jump right into it, and I'm going to introduce you, Steve. Hello, Steve.
Good morning. How are you?
Good, great. So thank you for taking the time here today. And I know there is always a lot of difference about private money, right? So explain for a brief moment, how did you get started yourself with private money?
A liquidity event, we found ourselves an opportunity to sort of get on the debt side of the real estate as opposed to the equity side. And it's basically the same underwriting, the same opportunities. We sort of limited on your upside potential, but protected a little bit on the downside. So we're more of asset-based lenders, bridge financing, hard money.
Okay, great. And just to give a brief introduction for people that don't know, how is the private money different than traditional financing?
Sure. Well, hard money, private money is more, again, just like the term says, it's private. You more have individuals or family offices or things along those lines. The traditional banking is more institutional. Every day, banks on the corner going through a different type of underwriting process. Getting to know the real estate in a different way from traditional appraisals. A lot of these traditional lenders use appraisal management companies and so forth. On the private side, it's a little bit more intimate. It's a little bit more direct, a lot faster. The terms are different, but for those differences, you certainly, you get some advantages. Of course, there's some disadvantages, but there's a lot of different intricacies when it comes to private money. It's really appropriate, in my opinion, and I'm happy to share and go into a little more detail. For the fix and flip market, for the investor, really for the long-term homeowner, it doesn't make sense. You're better off going more traditional, more institutional.
Right. Okay. And so since along those lines, what are then the benefits of using private money instead of traditional financing?
Yeah, so the traditional financing is, of course, like I said, more or less underwriting in a box, looking at certain things and certain metrics. The private money advantages are you can close very quickly. At our company, we can close as soon as one day. We get to know all of our clients, a lot of times on Zoom, a lot of times in face-to-face, and we can react quickly. We can look at real estate via FaceTime and WhatsApp. We can, really kind of do our underwriting in minutes as opposed to weeks. So there's a huge advantage from that perspective. The rates are typically higher, obviously, in this high interest rate environment that we're in today. The rates actually, the margin has closed quite a bit. It makes us a lot more competitive to the larger institutions. But that being said, we sort of play in our own box, right? We really focus on that investor that wants to close next week, that we don't do background checks or credit checks. It's really truly asset-based lending. We'll put a mortgage on the actual property and we'll lend to the property, if you will. That being said, we want to make sure that all the clients have the ability to make payments. We never put people in loans they can't afford. We've been doing this for almost 22 years. We've done thousands of transactions. We've been through, financial crisis, global pandemic, really every up and down market that you can imagine. And we've seen sort of everything. We always joke around. We've seen everything you could possibly see go right or go wrong on a real estate transaction. But there's a specific niche for private money, and it's really geared towards that investor that's looking to have a short-term financing liquidity need.
Right. Yeah, it's one of the things that you brought a couple of good points there. One of them is that, you want to work with somebody that has been through different times in our history, right? Through COVID and through 2007, 9/11. So those are things that made a change to history as we know it. And so to have been with a lender, or also say with a real estate mentor that have been through that and thrive through those is so crucial and important, number one. Number two is that, with private money, you can be a lot more flexible. I always say that having a good connection with a private lender is like basically having a blank checkbook, right? Because once you do that, then you establish this relationship. And the other thing is that you add a layer of protection for the investors, because a lot of time it's good to have another set of eyes going for your numbers and looking at the property, because like you said, you're never going to put somebody in a bad position or get in a bad loan, because otherwise you guys have to hold the bag at the end, right? So to be able to do that is another assurance that they're doing the right investment. So those are really, really good points, right? So I agree with you. But with this said, what are the risks here that potentially could be involved with private money?
Well, it's the same risk as any loan, right? So obviously, like you said earlier, we want to make sure the property is at the right price. Of course, when you've heard the term before, maybe you haven't, you make your money in real estate when you buy it. So obviously you want to get the best possible entry price. And then of course, depending on the asset class, whether it's, a fix and flip or even a commercial, or a multifamily unit, you certainly look at the rental income and things of that nature. But at the end of the day, it's really in the origination is really when you sort of make your decision, your underwriting process. So some of the risks are obviously, the investor underwrites it improperly. We always make sure they do it properly. We'll give our opinion to our clients. We don't charge for any of our time or any of our opinions. There's no appraisal fees or junk fees at our company. Essentially, it's in our best interest for our clients to make money. And we say this all the time, and really for three reasons. One, from a human perspective, we want to make sure it's nice when everybody obviously prospers and does well. The second reason, which you alluded to earlier, is of course we want to make sure they make money, because the more money they make, the safer our loan is, and certainly the more opportunity for them to, thrive and make significant profits. And the third reason, the more money they make, the more likely they're going to grow. And we don't really ever lose clients. Like you said earlier, we have a relationship with all of our clients, and we develop relationships where we get to know each other. We understand their interests, the properties that they like. Obviously, if they have a good pay history, we get more aggressive on our loan to value and our rates and things of that nature. We can certainly be more helpful in that category, but really, those are kind of the risks coming in. We want to make sure the property really is the right property for the right client.
Right. And so with that said, what are some of the common mistakes that you see a lot of investors do, especially as they start this journey?
Again, I would get back to purchase price. I think one of the bigger mistakes is people, will get excited about a property. For example, they'll fall in love with the property, and really, this is an investment. And, again, we're not talking about families buying homes for their families. We're talking about investment opportunities. Investors should never fall in love with a property, even the greatest property in the whole world. It's just a transaction, and there should be no emotional connection to the property. It shouldn't remind them of anything. It's strictly numbers, right? If the math works, do it. If it doesn't work, go to the next one. And there are thousands and thousands of opportunities every day. We also see some other mistakes being made at auction. Sometimes you get caught up in a bidding process where you're bidding another investor, and your emotions get the best of you. And really, the most disciplined auction investors have a specific finite purchase price they're willing to go up to, and not a dollar more. And those are typically the more successful investors. They say they underwrite the properties, and they say they're willing to pay X dollars regardless of what happens. Hopefully you get it at that price or lower. That would make it that much more obviously opportunistic and favorable. But really, that's another common mistake that some investors make, is they sort of get caught up in the auction. Third, you'd want to sort of understand the carrying cost of the property. A lot of investors might undervalue or underestimate their carrying costs. They might say, "Oh, I'm going to be able to flip this property in, say, 5 months." And, if it turns into 10 months, that could happen, of course, certainly in this market we're in today. And you have to factor in additional months of rental, mortgage payments and insurance carrying costs and things of that nature. Maybe the market shifts a little bit from a rehab perspective. So those are some of the other common mistakes, sort of undervaluing and underestimating the cost of the entire deal and the longevity of that deal. Giving yourself some extra time, assuming that, it may take longer. You sort of want to plan for the worst and hope for the best. That's kind of like my good, yeah.
Yeah. So with that said, if somebody wants to establish a good relationship with a private lender, what are some of the best tips of advice that you was coming from being a private lender, if somebody wanted to work with you or any private lender?
Sure. One of the things that we respect most is when people spend the time to come meet with us. We've had people flying from Michigan, Puerto Rico, Alabama, different markets. And if we feel like they're willing to spend, the day and get on a plane and really kind of get to know us, that goes a long way with us. I think that's one certain advantage. History, right? So if they have a good investing history and they could demonstrate, hey, I bought this property and I did this, that, and the other thing to this property, and then we had a liquidity event, we sold the property, we made a certain amount of dollars. Or even if they failed and they said, hey, this deal didn't work out for these reasons, and they were sort of knowledgeable and truly understood what was wrong, and they demonstrated to us that they really understood the business, that's very valuable to us. And then I guess the third thing, really being prepared. Coming in when you're presenting an opportunity, really, we don't love when people say, hey, can you do the deal for us? And they'll send us an address. That doesn't really work well with us. We like when people send in, this is the property we like, these are the reasons we like it, these are the comparables and why. This is the expected liquidity and a certain time frame. So sort of having your own ducks in a row prior to sending it to us.
Right.
It's not complicated. We're not asking for a long dissertation. It's simple sort of underwriting and showing us that you understand the business, understanding the investment opportunity ahead of you. And that kind of shows us you've done your homework and you're a serious person. And those are the kind of people we like to work with.
Right. And so, since there are a lot of beginner investors and a lot of people nowadays are interested in getting into rentals and fix and flip, and obviously they're looking at private money. So what type of advice would you give with somebody that is really just starting with using private money and real estate investing? How could they position themselves to be more appealing to a private lender?
Sure. Well, there's a lot of answers to that. So one is, going to a group like yours where you have professionals that are already experienced, taking on an advisor or a partner, somebody that's done it before. Maybe you give up a little of the upside, but you're sort of getting some protection and experience, which is very important, right? You want to understand what the market's looking for. You want to understand all the certain aspects of each transaction. And really, when you get that through experience, I mean, you can read all the books in the world, but really the best way to do deals is just do them. Be conservative, do them with an educated, experienced person or investor or partner, and sort of maybe go to your lender and ask their advice. Just become organized. And that's really the best way to I think, attack the business when you're getting into from the beginning.
And so, in your opinion, how many deals does a person have to do in order for you to consider them full-fledged investors and feel comfortable in working with them, experience-wise?
It's a great question. We don't really have a specific, box, so to speak, that we check off and say after they do 5 deals, we think they're a good investor. If they come in educated, they come in experienced, they come in organized, and we like the deal. Again, the deal is going to do itself, right? So if they buy the property correctly, they know what they need to do with that property. If it's a multifamily, if they need to raise the rent to a certain number and rehab certain units and sort of get that property in better shape, you don't have to have 20 deals to be a great investor. So you really need to sort of, again, getting back to your underwriting, the more deals you do with us, the better. Having a good pay history goes a long way with us. We don't really want to chase people. We're not a bank. We have a little over 100 and something clients right now. They're buying properties every month. There's no limit for our clients. Quite frankly, we actually like when our clients are growing and doing multiple projects at the same time. It's great for us. We can give higher loan to values. We can give more leverage. And not because we're sort of slacking off on our underwriting, but the more they're invested in the business, the more we can co-invest with them. It actually becomes a safer loan. So again, getting back to it, there really is no magic number. Just having some experience, being honest and forthright, sort of just, vetting the deal properly, that goes a long way with us. So even if it's a couple of deals, we help our clients. We don't take any percentage of the profits. We advise them because it's in our best interest for them to do well. There's no cost of anything like that. So that's truly, we're in this business for the long term. We've been doing it for almost basically a little 22 years now.
Great. So how can people find out more about you?
Well, we have a website, of course. It's swiftlending.com, SWIFTLENDING.com. My email is Steven, STEVEN, at swiftlending.com. We have a full staff in Boca Raton. We have an affiliated title company called Quaker Title. We utilize them because they are in the investor business. They understand how to, look at each transaction. So a lot of the times there's hair on a deal, whether there's liens or things that might scare away other investors. We think that's terrific because they can all be cured. So you sort of get better pricing when there's a little hair in the deal. So we work with those other professionals that understand real estate investing from an investment perspective, and we're quick. And, like I said, Swift Lending is what we've been doing. There are other competitors out there where I think we're priced actually very competitively. If you look at all the junk fees that my competitors charge, we have no junk fees and there's no upfront cost. So we're incentivized to close on every deal, of course, obviously, or we couldn't make any money. But we want to grow out long-term relationships. We're looking for repetitive investors that want to grow their business. It's a terrific business. The nice part about real estate investing, it's very transparent. In general, it's very safe if you do it properly. There's huge upside to make a lot of money. Not every deal is a home run. We tell that to all our clients. You have to hit singles and doubles also. You look at your real estate investing at the end of the year, kind of look at how you did. Obviously, you'll make some improvements. Not every deal is going to be great, but in general, it's a terrific business. We've been seeing our clients do very well over the years, and we're happy to be in it and help support, grow their business.
Right. Yeah, I think there is a big misconception in real estate, right? That you have to have the money or the credit or the finances to really get started, where it's more about really, finding the right opportunities, number one, then connecting with people that have the money, the old concept of OPM, right? Over people's money. And number
Sure.
three, get educated so you learn what to do and so that people will take you seriously. Obviously, as a private lenders, you want to see somebody that knows what they're doing, so they're not going to waste your time, and then you feel confident in loaning to them. So once you know you have those things in a row, then you can go ahead and start getting your real estate journey. You don't have to have a lot of money to pay for properties for cash. You can definitely leverage, the money and the knowledge with the right people. So great. Thanks for taking the time today to explain a little more. And we're also going to post your contact information here with the podcast. And anything else you want to add to close up?
No, I really appreciate your time today. Thank you much. Thank you very much for having us and me. And we look forward to doing this again and helping any of your clients with anything they might need.
Okay, great. Thank you.
Thank you. Have a great day.